Yeah.
We're live. Okay, for those of you that are home, we're just waiting for everyone here to grab a seat, finish up their food gathering and drinks. Got a great view of Russell's shoulder at the moment.
Sorry about that. With my head, you'll be away for you.
If you sit down, you'll be all right.
Is that right?
You're fine, buddy.
Good man. Thank you very much. No worries.
We're just saying that, yeah, it's odd that, normally we've got about 30 people in here, and this time the numbers have shrunk, but there's a ton of people online watching. So, yeah, so welcome to everyone. So that's great. We'll get stuck into the budget. Obviously, a lot of people have already heard a fair bit through the media the last day or two, but we'll try to cut through some of that a little bit, and hopefully I can get my recorder working. Looks like I'm doing it manually. We'll cut through what the media have gone through and try to make it a little bit more sensible to everyone. It's just a disclaimer, so it's not advised, not advice at this time. Okay, and just as I said, welcome to everyone that's on live. And I think you've got the ability to ask questions throughout, so I'll try to get through to those as we go. And obviously everyone here, if you've got any questions as I'm going, let us know. Okay, right, so to try to make something that a lot of people find boring a bit more entertaining and exciting, the analysis, well, we've been talking for years looking for a surplus, so we finally got the surplus that we've been after. So it's really good. Labor will take a lot of credit for that, but really it's been lucky. They've had a lot of money from the mining revenue. Treasury forecast the iron ore price to be $60 to $80 a tonne, and it's been up over $100 pretty much for the whole time. So that's added quite a lot of extra royalties. And also, as you'll see in a moment, there's actually a fair bit of actual tax from taxpayers being paid this year from last year. But having said that, I think it's going to be very hard for the coalition to argue with the budget that's been presented. But from I suppose from a lot of people that we deal with, it's been more targeted towards welfare recipients than people that are working. So it's really aimed at I'm going to, I suppose, say the lower class recipient. There's been a few questions about whether it's an inflationary budget, and there's probably arguments for and against it. We'll have a bit of a chat about that at the moment. I actually, as they were going through it, I was thinking it's a bit of a Robin Hood budget, but whether everyone agreed with that or not, it seems like they're taking a little bit more from everyone else and giving it to the poor, which is probably the way that Labor government would normally operate. And there were no secrets really this time. I think a lot of stuff was actually announced prior to the budget. So I'm finding that as the years go on, I think this is probably near on my 20th budget that I've presented, but they're really starting to leak everything earlier so that we don't get to budget night and find big surprises. So I just wanted to go back to when the coalition were there in 2020 and 2022. The plan back then was if we spend money, businesses will employ more staff and the economy will rebound. And they put a lot of investment into manufacturing and infrastructure to give us some jobs. And that's actually worked pretty well, but unfortunately it's actually taken us into a sorry, I've gone back one, into a inflation environment that we're in now. Just a couple of little hidden surprises that were in the budget. Unemployment's likely to rise, which means people will lose jobs. And if it's not that, it's going to be the new levels of immigration, which is going to add a bit more pressure to the domestic workforce. So they're looking at about 400,000 new skilled migrants coming into the country this year. Finally, there's only about 400,000 jobs left in the country that are available. So so that means that 400,000 our current workers probably end up back on unemployment benefits. But look, they're looking at that for tax purposes. We do need the tax revenue to keep the country ticking over. So the resources saw, as I mentioned before, saw a lot of extra tax being paid with the iron ore price up over $100. It's only been recent that it's dropped down from sort of around 120, where it's hovered for most of the last year or so, back down to around 100. One thing that hasn't really been well spoken about is the loss of the $1,500 tax deduction, which will affect about 10 million taxpayers. And but on the other hand, there'll be about 1 million people that benefit from lower power bills, but everyone else is going to actually be paying 25% more, which is the estimated cost of power over the next 12 months. There's a bit of tax for trucks and farmers, just on fuel, and also the farmers, which I haven't really put this in there, but trucks have to pay an extra 5 or 6 cents per litre on their fuel, which is going to obviously increase the cost of goods that we're having delivered and going to supermarkets and whatnot. And farmers actually have to pay a levy to help import food from other countries. So they have to pay a levy for their competition, which I thought was a really sneaky little thing. Sorry, I'm sweating so much. Okay, and the other thing which I thought was maybe good news is that the budget also assumes that there's no further changes in interest rates this year. So, so we're hoping it doesn't go up anymore. I think I'll say it a bit later, but I think there'll be at least one more, probably just one more. Okay, just a warning, straight after the budget came out, a lot of scam emails and SMSs went out to people offering a $750 government rebate from the budget through MyGov. So just to everyone that we look after, obviously we do our best with cyber security. We're pretty much on the front foot with it, but it's not something that the likes of yourselves might all have that same ability to protect yourselves that way. But I just want to say to people, if you're ever unsure of anything, just call the office and we'll be able to tell you whether it's genuine or not. And we've got facilities here where we've got sacrificial computers, so we can put emails onto that and test them out and see if there's anything wrong with it. But we know pretty much that most things are coming these days are garbage. So just protect yourselves. Right, revenue sources. I thought this was really interesting. So this is a breakup of where all the revenue in the country comes. I actually did this chart last year. And they changed it a little bit. Now we've got a different government. They've changed the format of the chart and they've changed the website link that it's on, surprisingly. It's been the same for 15 years. But anyway, the big things on this I wanted to talk about was company and resource. So last year, if I can just find that tax was 85 billion. So it's gone up to 133 billion this year. So it's a massive, massive difference. Individual income tax, as I was mentioning before, just taxpayers last year. I'll just try to find that figure was 224 billion. So that's increased by nearly $100 billion this year as well. And the fuel excise, interestingly enough, even after the 50% cut in the excise, last year it was 20.9 billion. So that's gone up $5 billion, even though we had that whole period where the excise was reduced. So some pretty big changes in, I just think, those couple of areas. And sales tax, which is GST. They've changed it from GST to sales tax, so it makes me a little bit wary. But that's gone up from 75 to 91 as well. So there's some pretty big increases in those figures. Where they're spending the money. So there we are, social security and welfare. I think if I go back about 5 years ago, I was saying there was more than just over 49% of the population on a government benefit of sorts. Now that figure is well and surely over 50% of Australians on some sort of government benefit. That figure last year, I had to convert this because they've changed it to dollars from percentages. Last year, that figure was 209 billion. So it's only a $40 billion increase almost in 12 months. Okay, that was the only one that was really a big one. Interesting also the health. Just when I was sort of looking at that, the health hasn't actually really increased that much. So I expect to see that health figure increase a bit more in the next year or two, especially with one of the measures they're doing where they're going to try to increase aged care funding and for the workers in aged care. And just on that, while I'm talking about some of the incentives that have been thrown to help people work in aged care, it's about a 15% pay rise that the government's funding. Interestingly, we've got this dilemma now where people that are maybe working in early childhood not getting the pay rises that they're after, and there's the concern that there might actually be a shift where people remove themselves from childcare and move themselves into aged care to get the fairer pay. So let's just watch that space. Okay, under the debt, this is just my year-on-year calculation just to see how we're going. So it's a little, there's a fair bit on the page, but if we have a look at where we started back in 1990, we had 96 billion as household debt, or if you want to look at government debt was 55 billion. Where we stand right now, household debt's gone from 96 billion up to 3.4 trillion, and that's even a massive increase on last year, which means that people are still borrowing, and the state debt's gone up, and the government debt's gone up a little bit as well. The net debt forecast, this is actually pretty good news. So what I've done here is, with the previous forecast, should be good if I'd spelled forecast right. What I've done is I've gone back to the coalition budget 12 months ago here, not the November budget from the Labor government. But if you have a look at it, government of the coalition were looking at a $700 billion debt. At the moment, we're actually at 548, or we're forecast to be that in the next month. So there's actually a big $160 billion turnaround in that, which is massive. So that's a really good news for the country. And as you can see, each year thereafter, it's going to be a better figure. So if we really look at it, in 4 or 5 years' time, debt's going to be about $200 billion less, which is billions of dollars of interest that we're not having to pay on that debt. But if you have a look at it, we were actually meant to peak back in 2026 is what was initially forecast, even at a higher level, but it looks like we're going to peak now probably a year after. So it's going to keep continuing for a little bit longer. Okay, peak, beautiful. Right, and the deficit. So this is just the budget figures. So as I've said, we're looking at a surplus of 4.2 billion. We'll get that exact figure at the end of June, but that's where they feel that they're going to be. If I go back to, again, the coalition budgets from 2021 and the year before, there's a big turnaround in what they forecast the deficit was going to be to now. But as we mentioned before, there was about $100 billion more out of mining and personal tax revenue, which has pretty much helped feed this surplus, which is really good. Next year, it's not looking too bad, a small deficit of about 14 billion, but I think if they play their cards right and be smart about it, I think they should be able to shave that down and get another year's surplus. So I think that'll be on the cards for next year, which would be really good for us. But then the years thereafter, we're looking at a little bit more deficit until it gets better. And debt to GDP, it's not something that excites a lot of people, but as our economy grows and the revenue of Australia increases, and we need to also be mindful that our level of debt is sort of like, I suppose, inflation for ourselves, but over the country. What we want to see is this debt to GDP figure low. So if we were looking again, coalition figures up around that 30% amount of debt to our revenue, it's looking like it's steady pretty closely around the sort of 23-ish mark, which is a lot more tolerable for us. And again, it's a lot more sustainable for Australia to have that lower debt there. So not an exciting figure, but the economy and the country certainly a lot more bulletproof with a lower figure than what we were actually looking at previously. So, if I just talk about those things in general, and most people know I'm a coalition voter just from a economic management perspective, which I wasn't really wrapped about the way they did that in the last years of their government. But you know, if you look at things now, you know, the Labor government's certainly able to you know, hang their heads high, I suppose, and they've actually done you know, a pretty good job, especially in terms of what they're forecasting with their management. And that is, as I said, though, it is on the back of probably some of the things that the coalition did, and a bit of luck with the extra mining tax and income tax from people as well. So anyway, as I said, I think we're looking okay. No questions? No one's got any questions? Good. Inflation, just have a chat about that because it's fairly topical for a lot of us, and it's causing a lot of grief for those that have got loans, and for those that are retired and have some term deposits. It's been quite nice times. So it's a little bit hard for us to balance. It's like when I'm buying shares for clients, I want them to fall so I can buy them for people, but all the other clients have got the shares, I don't want them to fall because they get upset. Right, so inflation, so coalition back in their day, these are the figures that they projected the inflation to be. They were just a little bit off, 4.25, but it actually peaked at 7.8 in December. So yeah, fairly significant, as we've all been really feeling the pinch on that. And if I come back to where the Labor government are looking now, so they're seeing that it's actually started to reduce, which is good. So the Reserve Bank changing the interest rates, well, increasing interest rates has done it's doing its job, and I think it's pretty much at its point where it's done its job. We're just going to have to put up with the pain for that as people with loans, and those that have got term deposits that have got that extra money. Probably not a bad time to start thinking about locking in some longer term deposits, because we'll probably start to see them fall mid to late next year. So inflation getting back into the normal range in the next year or two, and then hopefully, I'm not going to worry about 2026, but hopefully from that point there, we can actually start to see things steady down a little bit. So good news, inflation is dropping, which means interest rates are going to be able to start to reduce probably, as I said, towards the end of next year. Tax. So this is the slide I normally use, which is normally tax cuts, but I've actually put a needle and thread because they've actually increased some taxes on us. So I better fix the cut. So this is really sneaky and hasn't got a lot of attention anywhere. So I've got Paul in the room, who's an accountant, and be aware of this low to middle income tax offset. So, but basically, what it's been an extra tax offset that most people have been able to receive with their tax returns when they've been lodging it. So, as most people that are PAYG wage earners have their tax taken out each pay cycle, and then at the end of the year, accountants like Paul do their magic and get the tax back that they've paid over and above what the minimum is, and there's been this extra offset that's come back to people. So for people under 37,000, it's been 675, and then if you're up over 48,000, it's been about $1,500. Well, they've decided to scrap that now. So from Easter present, it's everyone's Easter present. There you are. So it's going to make Easter tighter for everyone. No Easter eggs. So that remains in force for this financial year. So as people do their tax returns, and some people are keen, do them on the 1st of July. Some people slack and do them at May 15. The year after. This year's will remain, but it's the year after where we'll see that this $1,500 will be cut. And that's a pretty significant cut because it affects a lot of taxpayers. Even those that are self-employed as well, depending on where your income is, that range, sorry, on the left, the income range, that tax offset's going to still be removed for yourselves as well. So as I've just said, the implications, this year's unchanged, means there's going to be lower tax refunds and we're going to have lower disposable income. So when we talk about whether the budget's inflationary, the fact is that they've taken somewhere between $675 to $1,500 out of most taxpayers in the country. That's going to be less available for us to spend, which is, I suppose, anti-inflationary. It should reduce the rate of inflation based on that. However, that's been topped up with what most people would have heard about, the $500 power incentive, which I'll talk about in a moment. Tax rates, so there's nothing changed. The tax rates remain exactly as they are for this current year and for next year. And the thing that's been taken to task a lot with, especially in the lead up to the election and still in the media the last few days, has been what's called the stage 3 tax changes. These come into effect from the 1st of July 2024, which is really to take out the 37% tax bracket and increase the 30% tax bracket to pretty much the majority of taxpayers. So as you can see in this last column here, 94% of taxpayers fit into these two brackets, and only the high net worth, high income earners are earning over 200,000. Their tax bracket will remain. So it's a big incentive for taxpayers. It's going to put extra money into our pockets, but it's been subject to whether this will be overturned or not from the Labor government, because it was a coalition initiative, was passed through the Senate and was legislated, but it seems more and more the Labor government trying to confirm that they're not going to actually roll it back or repeal it. So I think we're pretty safe with it, to be honest. So hopefully I don't get to eat my words next year. So my current thinking there is anyone that's got any surplus, just put it towards loan reduction at the moment. I know most people are really struggling, and it is taking its toll, but there's likely to be another interest rate rise. So if we can just try to give yourself a little bit of breathing space, that'd be good. I was saying this for the last few years. It's not for this year, but I've been saying pay extra while the interest rates are low. Put it into an offset or redraw account, and here we are now at this point where interest rates are higher. So hopefully a lot of people have been able to actually take on board what I've been suggesting there. So yeah, we do have the higher interest rates that pretty much followed exactly what I thought, except I didn't expect to have that 1 month pause that we had a couple of months back, and I expect that we'll probably see a pause now for the next few months, and likely one more raise, just to put a nail in the coffin, maybe around August, September, October in the year. And I reckon that should be the last one. Just for everyone that is currently subject to paying these extra higher interest rates, just maybe in terms of future planning, try to become accustomed to it. It might take a little while for interest rates to fall, but if you can manage on the higher rates and they do start to fall, if you keep paying that same level of rate as they fall, that's going to knock a lot of time, many years off your mortgage a lot faster and save you a lot more interest as time goes on as well. So try to manage within that, or as they drop, maybe don't just put all of that money back into your pocket and spend it. Put some towards a loan and just make sure you've got enough for another rainy day. Okay, superannuation. So there was not much with super, which is really good for most of our clients. So it's about time. So I thought I'll just hit on a few things that are relevant though. So the 50% reduction in the minimum, it's probably the most common question I'm asked any time I sit down with our clients. That has not been extended. So from the 1st of July, everyone with an account-based pension transition to retirement income stream or a defined benefit pension, you will have to take the full amount again, which I've got on the next page, the rates. Super guarantee, which I'll talk about in a moment. The 3 million total super balance, which I'll talk about. And I've just got some commentary around thresholds and non-arm's length income, which is relevant to self-managed super funds only. Right, so as I mentioned, the 50% minimum drawdown ends. So I know for many people that we look after in retirement, it's not everyone needs every cent that they have to take out. So the relief of having the 50% reduction has been quite welcome for people. However, from 1st of July, we do have to increase it. For those that are happy just taking the smaller amount, as many currently are, we can just continue that and then just pay a lump sum in June next year, which we've done quite often for a lot of people. But for some people that might want a little bit of extra money, and rather than getting a lump sum at that time, we can just start to increase that monthly payment that people receive. So there's no change at all to the percentages that people have to take. Those percentages have been in place since, oh geez, I want to say 2007. Might be a little off on that one. I reckon it's 2007. Super guarantee. This was previously legislated, but just to let everyone know that that rate that the employer pays into someone's super increases from 10.5% this year to 11%. Great news for employees, bad news for business owners. That's on its path to 12%, which we'll see achieved in the next 2 years, where it just goes up 0.5% a year. The other thing is they're going to, from 2026, see payment actually made at the time of the wages being paid. So currently the requirement is that it has to be paid quarterly on the 28th day at the end of the quarter, and now it's going to have to be paid with the salary payment. So that'll be likely a weekly or quarterly.
Monthly wages.
Yeah, Paul's just mentioned that see staff get used to monthly pay wages, which was pretty much the first thing that went into my mind when I thought about it as well. The main reason for this is, despite the fact that we've got the requirements and the ATO have got their portal and the data matching is so much better these days than what it has been for a long time, the non-compliance is still incredibly prevalent. There's so many employers still not paying the super guarantee. They're not getting away with it, they're getting caught, but if they go bust or whatever, it means the poor employee who was entitled to that money misses out. And we've seen some pretty horrendous figures over the years where people have missed out on $30,000-$40,000 of super payment, and then the employer's gone bust, and there's no recourse. If they're lucky, they might get a cent in the dollar. So by making it on the pay cycle, that's going to just help get that that level of non-compliance improved. They are actually allocating more money to tax office compliance through the budget as well to help. That was really interesting actually when I looked at that. They've tried to make it like it's to help employers by having more tax auditors come and scrutinise. So I couldn't quite work out how they were getting to that one. But look, as I said, the number of people that have suffered, it's been a lot. So hopefully this catches up with them. Now, I want to change this slide already. I've changed it about 4 times, and every time I hear something, it looks like it's different. So we'll go through the exercise I've done. For the people that this affects, I'm going to obviously deal with you on a one-to-one basis to try to get this right, because it is going to make a material difference to everyone that is in the higher super balance area. But the government, anytime they give examples, they use unrealistic examples, and pretty much the only example that's relevant to people is the one that's always missing. And they're basically still in the early throes of this, so there hasn't been much clarity at this point in time. So we will get more info on this, and what I'm showing you now is probably likely to change by the time this is implemented. So like I was just talking to someone, I think last week about this, that it was previously only going to be the accumulation account that counted towards the 3 mil, which effectively meant if you had 2 million in pension phase, and you would need to have 3 million in accumulation to be able to until you actually were affected. Now it's looking like it's going to increase, so affect the whole balance. So again, just watch this space, but it's a little bit of a nasty one. Pension income still will be exempt, I think, but we'll get clarity, and as I said, work with those affected. So I've tried to do an example on what we think's right. So if we use this as an example, and it's actually, funnily enough, a more realistic example than what the tax office used. So if someone's got, say, 2.2 million in pension phase and $1 million in accumulation. So the total balance is 3.2 million, which means we're over the $3 million mark. The fund earns 10%, which is $320,000. The tax at the moment is only on the earnings of the accumulation. So 10% of $1 million, $100,000, tax of 15% gives us a tax bill of $15,000. So I'll just let that sink in for a little bit. So that's as it is currently. So when we get to 2026, it's looking like this. So 2.2 million pension should be tax-free, tax exempt, sorry, as it is now. $1 million of accumulation takes us up at a 3.2. So we're only allowed 3 million in balance. So 800,000 of that accumulation plus 2.2 gives us our 3 million, which means we've got 15% on the accumulation balance of 800,000, which is 12,000. But the 200,000 that we're in excess of 3 million, that's going to be taxed at 30%, which gives us a tax of 6,000 on that 200,000 element, which gives us a total tax of $18,000 or $3,000 more than now. That's, I think, the best way I can articulate it at the moment. However, the tax office have got an example of a 52-year-old that doesn't have a pension with, I think, $6 million in their super. Again, I don't know where they find these people. And they're saying that they're just going to do a percentage of what the total fund is. And so at this stage, my concern is I don't know whether it's on the excess or whether they're going to put a total balance divided by and come back and do it. So potentially my concern is if the pension value with time increases to say 3.5 million, are they going to tax that 500,000 of pension money, the earnings on it? So I have a feeling that's what they're trying to get to, so that it is just $3 million. So it's a bit messy, but we'll just have to wait that one out. And sorry to be the bearer of bad news for those that have thought previously, and we've had other discussions to this point, but yeah, we just need to wait until we get that clarity. The next point with it is my concern is as that pension values go, and for a lot of our clients, we take out the minimum pension, but the fund's still growing higher than what we're taking out. So we're going to see that pension value increases, which means more of a percentage will be in accumulation, which means more money will exceed $3 million, which will mean more tax. So it's something that we're going to have to be really careful of. And I've actually just put down on the bottom, as you can see, we're going to have to make a decision whether it's better to leave it in super or to actually take it out of super and invest it individually, personally, in a family trust, however that may be. Because if we're paying 30% tax and there's no other income, then we may as well be investing it personally and paying a less tax. It'd be nice to go back to that tax rate slide, which I think by the time I muck around will be too much. So we're effectively saying, from the 2026, we'll have the stage 3 tax cuts in at that point, which means you could actually earn $200,000 and only be paying 30% tax personally, which would be the same rate of tax as you would in super if you had a fund balance over 3 mil. So it gives us a fair bit of scope to have a bit of a think about how we achieve that. I won't go into all the strategies because somehow the tax office, I think, keep getting copies of my budget strategies and closing loopholes. I do actually protect them, so only clients are actually able to see the presentations. So other thresholds mostly remain unchanged. So the concessional cap, which is our deductible amount that we're allowed to put into super each year, that remains at $27,500. Our non-concessional, which is our after-tax contribution, remains at $110,000, which means our bring forward concession, which is 3 years of $110,000, remains at $330,000. The only thing that changes is our balance transfer balance cap. So that's going up from 1.7 to 1.9 million on the 1st of July. So this is only affects people that don't currently have, that haven't fully used their what was $1.6 million super balance or 1.7 mil. If you haven't fully used that, the 1.9 comes into play. If you're still my age and not able to have a pension, then my transfer balance account amount will be 1.9 million. And then there's different rules on different percentages of how that's apportioned depending on what you've used previously. So that's good news. And one of the things which I think I might have mentioned, we did wonder whether they might have frozen that, because what's actually happened is it's meant to go up $100,000 in $100,000 installments. They've actually had 2 years jump in one this year because of inflation rates. So the concern is 1.9 next year could be 2, or the year after it could be 2.1, 2.2. So we're likely to see this rate start to really exponentially grow. Non-arm's length income, as I said, just for self-managed fund clients only. But we're very lucky. We attended to this a few years back when we sort of first got wind of it all. And the tax officers said all the way along that they haven't been applying compliance resources to this, which means they're not auditing it or not going to punish people for it. But in the budget, they sort of sneakily put in that it's only now talking about the stuff that happened up to the 2018-19 year. So I know our clients are fine, but anyone that's got a self-managed super fund where they've been maybe receiving discounted rates because they're an accountant or a financial planner, or they work at a big company that offers discounts for different services to super funds, you might actually find that the compliance resources are applied, which is maybe not what you'd actually be after, because the rate of tax is 45%, and that's very difficult to get out of. Centrelink. So for most of our clients, there's not a great deal of change. Again, it's probably aimed more at the JobKeeper area. But anyway, just for most people, just to let everyone know, from the 1st of July, we reach age 67 for being able to get the age pension. That's where it stops. It doesn't, there's nothing forecast to go beyond that at this point in time. So, but yes, you'll have to be 67 in order to get an age pension there. No changes to the age pension, so there's nothing to butter anyone up. There was no extra little incentive, no extra payments. Yeah, I thought that was a little bit disappointing. They've been given all the extra money to job seekers. So I've got a full list of everyone: job seekers, youth allowance, parenting payment, but yeah, no age pension recipients. So for, as you can see, $40 a fortnight increase for these people. The farm household allowance, it's for all the people that we've got now that are farmers. That's obviously going to be pretty handy in that area. Rent assistance, it was sort of thrown in the media about it was being a 15% increase to the amount of rent assistance that you received. What they've actually done is just increase the maximum amount that they'll pay it on. So I think I wrote that down. So currently it's $148 is where they pay the rent assistance to. They've increased that figure from $148 to $170. So it is going to put a little bit of extra money into most people's hands, because I don't know anyone that's paying rent less than $170 a fortnight anywhere in the country. One of the other things which was, I suppose, somewhat nice is job seeker over 55. So previously, or right to this day, if you're over 60, you get a higher rate of job seeker than you do if you're under 60. They've just increased that eligibility to age 55, just to give a little bit of extra money to those. Blank screen. Let's see. Work bonus. So work bonus, just in case anyone hasn't been working, the recipient of an age pension, and they want to go back to work, if you haven't had any, the amount that you can actually have banked up, which is currently 7,800, that's been increased to 11,800 to December this year. That effectively means that if you're on an age pension and you want to do a little bit of extra work and you haven't done work before, that you've got $11,800 extra that you can earn without actually affecting your age pension. So it might be, I'm not suggesting everyone goes back to work, but I know a lot of people are concerned about not being, shakes. Yeah, so it might be just a way to pocket, 10 grand and not have it reduce any of the age pension eligibility. If you have done some work, it depends on how much you've got banked. What's the rate? Kim, is it $3,500 or $5,000 a year for the work bonus? Is it 7,800? Yeah. Okay, right. So just give me an extra 4,000. Oh, well. This year it's 11,000. Yeah. Is it 7,800 a year? Yeah. Okay, there you are. I'm the expert on all the age pension and stuff, obviously. Okay. Well, it used to be 3,500, so it's increased a fair bit. Wow. So yes, that will be most beneficial to people that are on an age pension who haven't worked or have only worked a little bit and haven't used all of their work bonus. Right, energy price relief plan. They've got a name for everything. So this is the main list of everyone that's able to get it. So pensioners, Commonwealth seniors, health card holders, family tax A and B recipients, and then I'll talk about the small businesses at the moment. So $500 off the bill for the people at the top. So this is this is causing inflation, which has been offset by the $1,500 tax offset that other people have got. Extra $500 off the bill means you've got $500 to spend elsewhere. Now I know a lot of people that are retired, they don't have that money to spend, but I can tell you that people that are in the lower income bracket, every cent of money that is given to them is spent back in the economy. So so that's a real inflationary issue. So yeah, we're going to see that happen. Now, small businesses, it's actually really tricky to actually break this one down. Victoria hasn't come to the party yet with the federal government, but basically there's an energy bill relief of $325. It looks like it could be for people, businesses that have got a turnover of less than $10 million, but it could actually be not subject to that at all. What it actually comes down to is how many kilowatts your business uses and everything. So it's going to be a little bit tricky for people to actually work this out. Every other state except Victoria are matching what the federal government is giving, which is $325. But I believe they are still in negotiation with us, Victoria, to get it matched. So it'll be $650. So it's not massive, but again, any assistance to small business at the moment, I think would be quite welcomed, because I know a lot of small business owners are really struggling at the moment. And just in case anyone else has got some more money in their businesses, there is a small business energy incentive, which will give a 20% additional deduction for any investment into energy saving measures. And I've got this down that includes energy efficient fridges or assets that support electrification, such as heat pumps, electric heating or cooling, and things like batteries and thermal energy storage. So, if you spend $1,000 on one of these measures to help reduce energy usage, the government will actually allow you to deduct $1,200. So it's just a little bit extra for people there. Am I going for time? Oh, good. Nearly done. The end of the immediate asset write-off for the full expensing. So right this year, this is going to be the biggest thing. I think most accountants are going to get out to their clients and say, spend, spend, spend. There's no limit to what you can actually write off at the moment. So a business can go and spend $300,000 on a new asset and completely write that off as a deduction this year. That's been it has been temporary. It's been temporary for a few years, but normally the figure is $1,000, isn't it? Normally, $1,000. Yep. So we're seeing this being reduced down to $20,000 from the 1st of July. So as I've sort of said here, it's the full cost of assets has to be in your hands before the 30th of June. So if you're thinking about ordering a car, which is going to arrive in 9 months' time or 6 months' time, or the 1st of July, if it's not in your hands, you don't get the deduction. Okay. So they are, they can,
It's on the boat, it's on the boat, I'll check it for customers.
I thought there was an issue with boats being claimed on business. So Kieran, make sure Kieran gets this. Paul's just admitted that you can have a boat in the business. I still think it should be allowed. Not that I want it. So Paul was just saying that if you think that you're actually going to buy an asset that's not in your hands before 30th of June and try to write it off, the tax office are actually checking the likes of Vic Roads and everything and actually seeing what date it's been registered. So if that happens to fall on the 1st of July, then you pretty much get caught out. Yep. Immediate asset write-off. Okay, so just continue. So like I said, reduces to 20,000, which still covers a fair bit for people. So you know, if you're buying a new server, if you're spending up to $20,000, then you can immediately write it off. You spend $21,000, then it's depreciated.
It's always what 3 times.
I just told you that the tax office always get hold of my presentations. So, but yeah, like Paul just said, that does depend what's on the tax invoice. And a lot of people, when they do things like a server, there's the software for the licensing of Microsoft Server software or the access to 365 or Office or whatever. And sometimes the IT providers just bulk that all into one bill, whereas really it should be done on 2 separate. One should be for the hardware and one should be for the software, because there is a difference in the way that's treated. I'm sure that's what you were trying to say. Yep.
Mm-hmm.
Also, just things like business furniture and everything, you do have to look at the group of things. So if you go and buy 20 tables at $1,000 each, that would really be assessed as one $20,000 asset, not $21,000 assets. Okay, moving on. So I'm nearly done here, which is really good for everyone. These are things I'm just watching in the future, and I'm being quite mindful of. So the first one, freezing of the transfer balance cap to 1.9 mil. Whether it's 1.9 mil, but as I said, I think you'll see this go to possibly 2.1 million next financial year. So from 1st of July 2024. And I think if that keeps escalating, and especially if it's jumping in $200,000 or more amounts, there will be a point where maybe in 6 or 7 years' time, we're going to have pension limits at $3 million, which is close to the $3 million transfer balance cap amount, transfer balance account measure that they're looking at. And then if it goes to 3.1, how's that all going to look? So I think there's going to be something that's going to be played around within this space in the next 4 or 5 years. Capital gains relief comes up often. We've got a Labor government who are really anti the 50% discount on capital gains for assets that have been owned for more than 12 months. So currently you make $100,000 gain on some shares or property, you get a 50% discount on that. So only half of that gain, being 50,000, would be assessed at the marginal tax rate. There's a lot of voice to see that 50% discount reduced to 25%. So I hope if it does come to that point, they say as of a date, but maybe the more confident this government becomes, and I think they've got every right to be confident, because I don't think they've got any opposition at the moment. There's more likelihood of this type of thing happening. And if that happens, it's going to obviously put more tax revenue in their pocket, but cost us as asset owners more as well. Family trust income distribution, we've already seen a couple of changes there where the money actually does have to flow, but there's a lot of attention on the fact that those that are family trusts and then go and give money to grandchildren or children that are not working or have lower incomes. So I think that'll be cracked down in the coming years. Increase the GST, that's it's looking like that could be another measure that we might see. We've been very lucky that it has been frozen since we actually had it introduced, but it's a bit of a concern. But I think it's an easy grab, and whether they do 1%, which I reckon would be not where they'd be. They'd probably go from a 10 to like 12.5 or something like that. So just be mindful of that, because that's an easy grab for them, especially as in a time where they're trying to reduce deficits. The stage 3 tax cuts, as I mentioned before, I don't think the Labor will remove those. And there was actually something that came out this morning where Bill Shorten reinforced that they're not looking at doing it. Any of the commentary around it possibly being removed is driven by the coalition to try to just, I suppose, off-put the general public there. And I think we've got 2 to 3 more Labor government election wins. As I just said before, I don't think there's an opposition at the moment. And I think they've got every right to be confident in themselves. We've just seen, Paul and I have had a fair bit of discussion about how the balance of power sits at the moment. If the coalition actually want to stop anything getting through, they have to get the support of the independents, the Teals and Jacqui Lambie's party. And that's why we're seeing nice developments of the new stadium in Hobart and everything. Tasmania is going to be really well looked after to make sure that the coalition can't block anything. Yeah, Russ.
Do you think negative gearing could be?
That's a good point. I didn't put that up. I think that'll be something else that's going to be looked at as well. So yeah, the Greens big pushes for the negative gearing to be ending. I don't know how that would look if they do it, whether they just stop the deductibility, which I think would be madness in terms of the fact that they're worried about a housing shortage at the moment, especially with 400,000 more immigration numbers to come through this year and another 325,000 the year after. So we're looking at nearly 750,000 new people in the country. We've already got a housing crisis. So if you're not giving any incentive for people to build, how are you going to accommodate those? Now they have actually put some allowance in the budget for that, which I didn't think was really relevant for today, but there are some incentives there.
All I got to do is look at what happened in the 80s when they introduced it for 3 months or something, and then said, all the building stopped. Oops.
Yep.
So reversed it.
Yep.
Housing development of rental properties just died, and the housing crisis sort of got really worse because they didn't expect people to stop investing in housing.
No, but I think at the moment, like I think it's unattractive to buy an investment property. And I'm not saying this to sway people one way or the other. I know I've got clients that love property, and I know clients that hate property. But I'll look at it at the moment. The tenant's got every right under the sun, and there was just a ruling earlier this year. I've got it if anyone wants to reach out to me, where the High Court actually ruled that a tenant wasn't able to be evicted when they were given 4 months' notice. They hadn't been the ideal tenants, and the landlord wanted to renovate the place to sell it, and they were ruled that they weren't allowed to evict them because what was the rule? What they come under? They couldn't find alternative accommodation elsewhere. So now you've got this situation where you've got a tenant that can go in there. If they want to put pictures up on the walls, they're allowed to put holes in the walls to put the pictures in, good or bad. If they've got animals, if you're not an animal person, the dog can go in and wee all over the carpet. So you can dry clean that, but it doesn't get it all out. And so what I'm just seeing now is like, well, these are things that are going to cost a landlord more and more money. Then take away the 50% discount on selling the property, take away the negative gearing, take away the ability to actually ask the tenant to move on after giving them adequate notice. It makes it pretty tough to actually make that decision as to why would I want to buy it? And what's our rental yield at the moment? Less than 2%.
Statutory expenses.
Statutory expenses. Land tax. We were talking about land tax the other day. Doubled.
We'll get to the point where it is like in America where you pay people to leave.
That's right.
Pay your tenant, and we'll give you $10,000 to move on.
Yeah, so I've actually
renovate, pull down the property, whatever.
Yep, I've actually said if I was buying a property, I'd actually buy it and not have a tenant in there, and just let it sit there and appreciate capital gains. You're not going to get all that wear and tear on the walls and carpet and everything.
So the squatters moving.
The squatters, but I remember when I had properties years ago, like every time the tenant moved out, It was a week's worth of work. I had to repaint the place, replace the carpets. Some places I had to get scrapers and scrape the fat off the walls and all the fans.
A couple of guys had to get it. By the time the tenants got out of there, they lost money.
So
That was their safe, that was their pension investment.
yep. So
It cost them.
it's
People in there wrecked every
Yeah.
dollars.
that happens.
So it just shows though that,
Sorry, everyone online if you can't hear everything.
having a good, real estate agent to manage it, get the tenant is working.
Yeah, for sure.
Particularly
Yeah.
initial tenant, anyway.
Yeah.
When it's on renewal of lease or something, you've got a good one, you don't necessarily have to stay with the agency, but getting a good vetting process is worth.
For sure. So I'll move on and we can talk about that later. But I think that's a really good point is, having a good agent that's able to actually make sure they do vet the tenants is important. And that might be one of those agents where you've got to pay a little bit more for, because I know most people that are letting their places out, they're really screwing the agents down hard on their pricing so that they're not paying as much to have it let out. But that's probably opening up worse tenants that can be in the place. Having said that, you can have wealthy tenants in there that are just as destructive as well. But as I said, look, there's a lot of people who have made a lot of money out of property, and I'm not, personally, I'm not in property, but I don't sort of encourage people one way or the other. But it's just, for me at the moment, I'm like, where's the incentive? And I'm not seeing the incentive on it. And I've just mentioned that, I think they've got Labor governments in for about another dozen years at the moment. So we'll see how that goes. That's not good, is it? I was going to just mention, I have to find his name. Does anyone know the Shadow Treasurer's name off the top of your head? See that? No one knows his name. See, irrelevant. Angus Taylor. Angus Taylor. Who is this guy? Like, I've dead set. Sorry, Angus, if you're ever watching this, dude. Like, mate, your response after the budget, it was appalling. You couldn't even get a word out of your mouth straight. You had no idea what you were saying. It was embarrassing that he actually got up there on national TV, on ABC and Sky News, and tried to actually get something out of his mouth. He was useless. There was no way he was convincing anyone. Whereas, you look the other side, they were just, on point, everything. They were so well in the way that they delivered it. So, again, it just goes to show the difference in finesse between the two governments. Time was saying, it's a lot of expense, and a lot of things where $1 billion has been given. Realistically, if you gave 700 million, it would have the same impact and there'd be less wastage. But billion just rolls off. Discipline. They were very big on talking about discipline a lot. The Labor government, that this budget surplus is all as a result of discipline. They had two words: discipline and something else. Responsible economic management. Yes, responsibility, restraint, responsible economic management. Look, I think it was mentioned a lot, but I think most of it was luck. I'd say if we get to the next budget and we see another surplus, then I would say congratulations, they've actually done their job well. As I said, though, I think there will be another surplus just based on commodity prices, the immigration levels coming in, the business tax, and one of the things that I don't know whether anyone noticed today, there was a lot of media attention on the NDIS. So you saw that there's actually about $75 million, $1 billion worth of NDIS savings over the next, I want to say 10 years. I think it's 12. Got it here somewhere. Doesn't matter. So it's a lot of money that's there. But if you look at it at the moment, they're actually saying it's over 10 years, 74 billion over 10 years. They're actually saying that nearly 14% of the budget at the moment is going to NDIS payments. Now, it's a lot of money. And I said when the NDIS first came out, I said, you watch this blow out, and it's just blown out more and more and more. they're aiming to cap it at 8%. So, and that then everyone has to work within that limit. But anyone, one of us that I know, anyone that's working in the NDIS, it is just a rort. The money that they are making is ridiculous. I know people that might charge out their services at $80 an hour. They go through a NDIS facility and it's like, oh, no, it's $280 for us. That's what the government will pay you. And then they'll get like half an hour paid travel each way. So it's not, here's my business, I normally charge out at $80 an hour. And they go, oh, great, we'll use that. They're saying, no, make it 280 because that's what we'll do with the government. So there's a lot of that behavior going on. And not even just some of the services, like a wheelchair that might be a $250 wheelchair, being sold for $1,500. Just a lot of ways. Yeah, government money.
I had an accident back in '95, and I saw the bill that I worked for Australia Post at the time. I saw the bill that they were going to send Australia Post, and the bill that they were going to send RTA. And it was a hell of a lot more. One than the other. The comparison was absolutely wrong.
Yeah, that's crazy, isn't it?
And it was back then. So
yeah.
Nothing's changed.
I just waste all the time. Like I know people even that work with local government stuff. The money that is just wasted there as well. I say this every time, but there's a lot of businesses out there that are really struggling at the moment. So I just really encourage people to just support them. It doesn't necessarily mean you have to go there and buy their goods. If you can, that's great. But it's amazing just how things like sharing a social media post or liking a post, it makes a big difference to them. Comment something nice. It's really nice. So just try to get behind any of the small businesses out there, because they're the ones that really do try to look after our communities, and ultimately that sort of benefits. If not us, it benefits our families and our children. For us, I was really excited the other day. I saw we've got 9 Google reviews. It'd be nice if, I think one's yours, Phil. Yeah, nice if we get a bit more than 9. So I might just ask, if you can, maybe it'd be nice to sit here next year and say we've got 90 Google reviews rather than 9. I know we've got a lot more than 9 clients. Now, if you're going to leave a 1. Yeah, I'll just say Russell's going to leave you 1 star. He's like, I don't like that 5 figure. I think we do for the vast majority of everyone. We do a fairly amazing job. We really try to be exceptional at what we do. So it would be nice if we just got an extra review or 2. I might have to, before you leave the office, before you give you the pass to use the car park, leave us a Google review. We're going to stitch you up. And I say this all the time as well. Probably the one comment I get the most in our meetings is, I wish I had have seen you 5 years, 10 years ago. If you happen to come across people that you think can use our services, please pass them on to us as a referral. We do love to help people, and rather than 5 or 10 years down the track where it passes, let's get onto them a little bit earlier and make things a little even better for them. That's it. Any questions? So I'll see if anyone's got any questions here, and then I'll come to everyone here. Other than that, though, we're through in record time. It's good when the government don't make too many changes to superannuation. I'll leave that up. No questions? This is good. Oh, okay, there's one. Yes, Greg.
It's the 3 million total super balance. For that to go through, is that going to be a piece of legislation, or is it something that the Treasurer will just put out a paper on, or something that is debatable? And
it's still got to be passed, so it's still got to be put through. But this is coming back to what I just mentioned before about the balance of power in the Senate. The only way I can see it being blocked is the coalition have to get the Teals. Well, the Teals will probably go with the coalition, but that's not enough. They need the independents and Jacqui Lambie party. What was it? 2 or 3 seats. She's got a party now anyway. So they need all of them to vote with the coalition, and that'll be a 50-50 block. They can't actually get anything better than that.
Certainly to get through, but Labor's going to need the Greens, etc. on side. So there's no way it won't be what you're postulating up there, because they'll be looking to get as
Oh,
much as they can. from that.
yeah, the Greens will, obviously they'll side with the Labor. I mean, if the Greens had their way, it'd be 1 million or $1,000. So no, it'll get through. I just can't see there's any possibility. And as I said, now we've got a stadium being built in Tassie, and they'll start building a dozen hospitals. They'll just do whatever they need to get the Lambie side. Sorry, Greg.
Yep, I'm happy.
Yeah.
I think franking credits and the changes in legislation they're proposing on the off-market togos and things like that. Do you think that's gonna happen or not?
It has happened.
It has.
Yeah. So this is the franking credits. Yeah. So this is the franking credits on the not the share purchase plans. The other ones.
Off-market togo.
Yeah,
Off-market buyback.
What's the other one? The buybacks. Sorry. My brain's all budget fried at the moment. Yeah, so that was presented last budget, and yeah, so that's happened, mate. So we're not seeing any franking credits coming back through the buyback system now. I've seen there's some discussion about how some of the companies might try to restructure this a little bit to get the franking credits out, because a lot of companies have got excess franking credits that they can't distribute anymore. So it was always good to be able to do the buybacks and get the extra tax credit back. So does anyone remember what BHP's, what was theirs? It was like it might have been Rio. It was like a $2 capital and $80 franking credit or a frank dividend. So look, I know they're trying to be creative how to do it, but I'm pretty sure at this stage the Labor government have got that pretty much canned for them.
Are they able to just do one-off special dividend?
They can do it, but they need the money to do it. Probably do like Telstra do and just keep lending money to pay a dividend. That'd be one way to do it. Make losses each year, then go and borrow money to pay a dividend. That'd free up some franking credits.
Also, part of that legislation to try and stop them attaching a loan to a dividend.
Yeah, well, they wouldn't be doing it that way. They'd be just saying they were refinancing for another reason. They can get around that. But yeah, I think the only way it's really going to happen is somehow the company's got money in the bank, they generate a loss or a low profit and still distribute the money in the bank as a frank dividend. I think we're just going to have a lot of companies that are going to have excess franking credits just built up now. Unless somewhere down the track, which I don't think would happen, coalition comes in and repeals it. But most of the time, whenever a nasty tax change has occurred, no one really wants to come and bring it back. Thanks for the update. I'll visit the website for a Google review. Lol. Thank you. Okay, well, this is easy. No more questions. Good. All right. Yeah, okay. Yeah, I thought you were putting your hand up. Okay, thank you. Another one. Oh no, that's another thank you as well. That's okay. Everyone's quiet tonight. Any questions on anything else? I was going to put up some share tips, but I didn't.
Why not?
Okay, I'm just going to end this live stream here. So thank you everyone that joined us. Hope you enjoyed it. Still a few of you there. Wave.
Best tips Collingwood for the grand final.
Collingwood, yeah. Go Pies. Better than that Hawthorn team.
I worked
No, we haven't even. Yeah, it was fun. That's the other one.